I'm Kyle with Fundamentals of Finance, and today I'll be teaching you the ins and outs of 401k plans, including what they are, how much to contribute, and how they compare to other retirement plans like 403bs, SEP IRAs, simple IRAs, traditional IRAs, and Roth IRAs. In the next video, I will cover how to select investments in your 401k or whatever retirement plan that you have. Admittedly, that video will be a lot more juicy than this one, but we can't put the cart before the horse. Keep in mind, this is not financial advice and is my opinion only. So let's start with the basics. 401ks, 403bs, IRAs, SEP IRAs, simple IRAs, and the many different types of pension plans are all just vehicles to help you save for retirement more tax efficiently. They are not investments themselves. They are types of accounts you can put your investments in. All are geared toward retirement and all give you tax advantages, but each works a little bit differently. And if that sounds like options overload, don't worry. It's highly unlikely you have access to all of these. So in reality, you'll likely only have one or two options to choose from. In the first part of this video, I'll go through how to think about the right amount to invest. Then I'll go through how each type of plan works to help you decide which one or two are right for you. And in the next video, I'll finally give you some tips on how to choose investments in your plan. Of course, I can't give personalized advice to this channel, but after seeing literally thousands of these plans and helping many people in many situations make these decisions, I'm confident that by the end of these two videos, you'll have what you need to feel good about making decisions about your own investments in your own plan. And don't forget, you can use the chapters below to skip ahead to the plan that you're most interested in. I think a good place to start will be with pension plans, since there's not much I can say on those. These might be called a pension, which is a general term, or something more specific like a cash balance plan or money purchase plan. The distinguishing feature is that the company typically makes the investment decisions and the contributions. So nothing for you to do, which is why I won't spend more time on those here. For the others, you will have some decisions to make. First and foremost, if there's only one thing you take away from this video, I hope that it's if your company matches your contributions in any of these plans, you should at least contribute enough to maximize their contributions. It's free money. Unless you desperately need every penny for an emergency or for basic survival, it's usually a no-brainer to contribute at least that much. Not every company matches, and the amount will vary from company to company, but you can think of it this way. If your company has a dollar-for-dollar match or 100% match up to 3%, it means that when you put 3% of your income into your retirement plan, the company puts another 3% in there. So you've only put in 3%, but now you have 6%. Or in dollar terms, if you put in $3,000, you now have $6,000. Essentially a 100% return right off the bat. A general rule of thumb for how much you contribute to a retirement plan is 15% of your income. Coming up with a personalized figure is extremely complicated, so much so that it's often a major topic on the level 3 CFA or Chartered Financial Analyst exam. I'll cover how to do that in the advanced course I'm creating, but for now, here are a few factors that might influence that 15% figure up or down. You should consider contributing more than that if you've been working for a while but haven't started contributing to a retirement plan yet, you want to retire early, you can afford to do it, or you want to invest more conservatively than a typical person of your age, which I generally think is a bad idea, but we'll get to that in a few minutes. You should also consider contributing less than that if you might need the money for an emergency or to pay basic living expenses like your rent. It's awesome to have a huge 401k and set yourself up for the future, but needless to say, it's probably not worth it if it means being homeless today. Okay, so let's dive into the different types of retirement plans you can participate in. 401ks, 403bs, SEP IRAs, and simple IRAs are all types of retirement plans that you access through your employer, meaning that unless you have multiple jobs, you most likely don't have a choice between these. You have what your company offers you. 401ks are by far the most common. If you work for a large or medium-sized company, this is probably what you have. 403bs have some nuanced differences, but overall they're very similar to 401ks with the same tax benefits, the same contribution limits, and the same retirement age, 59.5. The key difference is that 403bs are offered to nonprofit and government workers like teachers instead of people who work at for-profit companies. If you work for a small business, your employer might offer a SEP IRA or a simple IRA. These should not be confused with IRAs, which are a little bit different. We'll get to those next. The key difference between a SEP and a simple IRA is that in a simple IRA, you and your employer can make contributions, whereas in a SEP IRA, only your employer can. While you can contribute to your simple IRAs, your employer can't contribute as much for you as they could in a SEP. They can either offer you up to a 3% match, similar to our example earlier, or they can contribute 2% to every employee, regardless of whether they contribute or not. That means you probably won't be getting much more than a few $1,000s from your company in a simple IRA, regardless of how much money you make. Employer contribution limits are lower in simple IRAs than any of the other employer options we'll discuss here. The contributions you can make are also lower in a simple IRA than they are in a 401k or 403b. The numbers generally go up annually, but for 2022, the contributions most people can make are capped at $14,000 in a simple IRA versus $20,500 in a 401k or 403b. Perhaps it's no surprise then that the total contributions, meaning the ones you make plus the ones your employer makes, are also lowest in the simple IRA at $14,000 plus their match, which I mentioned was capped pretty low, versus SEPs, 401ks, and 403bs at $61,000 for 2022. Last but not least, let's talk about IRAs. This is where some of you may have a second option, even if you don't have two jobs. Anyone who has eligible income can contribute to an IRA, but if you make too much money, there will be some key limitations. We'll get to those in a minute. There are two types of IRAs, traditional and Roth. 401ks and 403bs also have these same options, and they work the same ways, except for the compensation limits, which work differently in IRAs than everything else. Where you see the $305,000 figure for the SEP, 401k, and 403b options, it just means that employer contributions can only consider your income up to that level, not that you can't participate or get all the tax benefits if you make more than that. So, for example, if your employer matches your contributions dollar for dollar and you contribute 1% of your $400,000 income or $4,000, they won't be able to fully match your $4,000. They can only match your 1% contribution for the first $305,000 you make, so you just get $3,050 in employer contributions. With IRAs, there is no employer involved. It's just you. So anyone can participate as long as they have eligible income, but the compensation limits here are really important to consider. All of the traditional options, whether IRA, 401k, 403b, make your contributions tax deductible. That means that if you make $70,000 in a year and contribute $5,000 to one of these plans, you only have to pay taxes on $65,000 of your income. The $5,000 you contributed is deducted from the amount you owe taxes on for that year. If you're on a W-2 and have taxes automatically taken out of your paycheck, that means you'll probably pay too much during the year and then get back the difference as a refund when you file your taxes. Like I said, anyone can contribute to a traditional IRA, but not anyone can take advantage of the tax deductions on their contributions. If you're single and make over $68,000, or married filing jointly and make over a combined $109,000 with your spouse, you start losing the tax deduction benefit. If you make over $78,000 or $129,000 respectively, none of your contributions will be deductible. Your money still grows tax deferred, which is still a tax benefit, but you lose the main one. A Roth IRA, Roth 401k, or Roth 403b sort of works the opposite from a tax perspective. Instead of contributions being deductible, where you don't pay them now, but you do pay them when you take the money out, Roth contributions come out of your regular taxable income today, but are tax-free when you withdraw the money. For Roth IRAs only, not 401k or 403bs, you cannot contribute if you're single and make more than $144,000, or married filing jointly and make more than $214,000. Eligibility is also phased out a bit before that. And there are lots of other little nuances with these plans that you can find on the IRS website, but I won't bore you with them here. Let's focus on what's important, and this is a big one. Generally, the way to decide between the traditional and Roth option is that if you think your tax bracket will be higher down the road, go with Roth and pay the taxes now. If you think your taxes will be lower in the future, go with traditional and pay the taxes later. I can't predict what the future governments will do to the tax rates. My educated guess is higher, but either way, most people will be in the same or a higher tax bracket when they're retired than when they're working. Because think about it. Once people suddenly have a bunch of free time to travel, golf, or whatever else they're into, they don't want to take a huge pay cut and be stuck at home watching QVC.
Gary, let's talk about the fabric, but also the way that you did this.
And guys, that's really the moral of the story. All this detail about retirement plan nuances, and what I'm really trying to say is just make sure you contribute and contribute early. Otherwise, you'll be destined to retirement of QVC. Before we get into the next video on how to choose investments in your plan, there's one more concept I'll briefly touch on, and that's vesting. This applies to retirement plans and essentially means that you have to stay with your company for a certain period of time before you get to keep the employer contributions to your retirement plan. Anything you contributed is yours immediately. For a simple example, a company I used to work for had a very generous retirement plan, but had a 6-year vesting schedule. So after 6 years, all the contributions they've made up to that point and thereafter stay with the employee when they leave the company. But if they left after 3 years, for example, they would have only gotten to keep 40% of them. After 5 years, they would have kept 80%. In the next video, guys, I will cover how to actually select investments in your 401k. So make sure you're subscribed and click the bell so you don't miss it. If you want to learn how to invest like a professional, check out my free webinar below. The link is in the description, called the 9 Habits of Successful Investors. Thank you for watching, and I will see you in the next video.